IonQ INOK, the quantum disconnect, analyzing the infrastructure of tomorrow. The market is currently closed, and as of the final bell on Friday, IonQ stock finished the trading session at $27.82. We saw a slight retracement of roughly 1.2% intraday, capping off a week of significant volatility that has left retail and institutional participants alike scrambling to assess the true floor for this asset. When you pull up the chart on your Fidelity mobile app or glance at the numbers on your Interactive Brokers platform, the immediate expectation is that you are looking at a speculative science project, something that belongs in a laboratory rather than a portfolio. The general consensus suggests that quantum computing is a decade away, a futuristic concept that will eventually change the world, but currently burns cash with reckless abandon. That is the expectation. The reality, however, is far more aggressive and immediate. We are seeing a fundamental shift where quantum mechanics is moving from theoretical physics to applied infrastructure, specifically targeting the bottlenecks currently slowing down the artificial intelligence boom. This disconnect between the science project narrative and the AI infrastructure reality is exactly where the opportunity and the danger resides. Most investors approach IonQ with the same mindset they apply when they invest online in standard tech names. They look for linear growth, clear price-to-earnings ratios, and predictable quarterly guidance. But applying traditional metrics here is a mistake. The recent price action tells a story of accumulation masked by volatility. While the stock dipped slightly in the last session, looking at the volume profile reveals that selling pressure is drying up at these key support levels. Unlike Tesla stock, which has a massive float and global liquidity, or Apple stock, which moves with the weight of the entire index, IonQ is a tighter, more coiled spring. The movements we are seeing now are not just random noise, they are the result of a tug-of-war between short-term traders using Robinhood cash management accounts to capture quick swings and long-term funds positioning for a multi-year hold. When you see a stock hold the $25 to $27 range despite broader tech sector weakness, it signals that the bid underneath is real. The market is beginning to price in something that isn't on the balance sheet yet. The realization that classical computing, even with the mighty Nvidia stock leading the charge, is hitting a physical wall. Let's look closer at the intraday mechanics we just witnessed. Throughout the last session, we saw repeated tests of the lower trend line. A novice looking at a Robinhood stock trading chart might interpret this as weakness. However, if you layer on institutional data from a Fidelity trading platform or analyze the order flow through Interactive Brokers stock trading tools, you see that these dips were bought up rapidly. This behavior is characteristic of iceberg orders, large buy orders split into smaller chunks to avoid spiking the price. It suggests that while the retail crowd is nervous, larger entities are quietly increasing their exposure. This brings us to the broader environment of online investing. Platforms like Schwab Intelligent Portfolios and other automated systems are often underweight in these high beta names because their algorithms prioritize historical volatility over future potential. This creates a lag. By the time the SoFi robo-advisor models rebalance to include a stock like IonQ, the initial explosive move has often already happened. This structural inefficiency in how passive money flows into the market creates a window for the active participant who is paying attention to the actual technology rather than just the backward-looking volatility metrics. The narrative surrounding the tech sector right now is heavily focused on AI, but few are asking the critical question of what powers AI when the current chip architecture reaches its limit. This is where the tension between expectation and reality snaps. The expectation is that we just keep making chips smaller. The reality is that we are approaching the atomic limit of silicon. IonQ is not just building a faster computer, they are building a different kind of physics. Their focus on trapped ions offers a level of fidelity, pun intended, that superconducting qubits struggle to match. While competitors are dealing with error rates that make commercial application difficult, IonQ is pushing towards algorithmic qubits that can actually solve problems too complex for classical supercomputers. This is the angle that the market is only just beginning to wake up to. It is similar to the early days of online investment when people doubted the security of putting credit cards on the internet. Now it is the standard. Similarly, using quantum processors to optimize the logistics for a shipping company or to simulate molecular structures for a pharmaceutical giant seems exotic now, but it is rapidly becoming a competitive necessity. We must also consider the macroeconomic backdrop influencing these movements. With interest rates hovering where they are, capital is expensive. This usually crushes pre-revenue or early revenue growth stocks because their future cash flows are discounted heavily. However, IonQ has defied this gravity recently. Why? Because the scarcity value of what they possess outweighs the cost of capital. When you utilize SoFi investing or check your Fidelity IRAs, you're often told to diversify into safe assets during high-rate environments. Yet we are seeing a rotation back into hard tech, companies that own difficult-to-replicate intellectual property. It's easy to start a software company. It's incredibly difficult to trap ions in an electromagnetic field and manipulate them with lasers. That moat is what is driving the valuation. The Fidelity Wealth Management divisions and high-net-worth clients at Interactive Brokers are looking for asymmetric risk. They want assets that can do a 10x, not just a 10%. In a world where the S&P 500 is crowded, funds are forced to look at the fringes, and IonQ is the leader of the fringe. This brings up a critical point about how individual investors engage with this stock. If you are using a Robinhood app or engaging in self-investing through a standard brokerage, you're prone to emotional trading. You see a 5% drop, and you panic. You see a 5% gain, and you get greedy. But in this sector, a 5% move is noise. It is effectively flat. The volatility here is a feature, not a bug. It shakes out the weak hands, the tourists who are just here because they heard a keyword on a news segment. The survivors, the ones who hold through the chop, are the ones who understand the timeline. We are looking at a company that is transitioning from a research lab to a factory. Their new manufacturing facility in Seattle is a testament to this shift. They're not just thinking about one computer, they're thinking about how to build these machines at scale. This is the Tesla stock moment for quantum, the shift from prototype to production. Let's pause on the technology for a moment because it is often misunderstood. Most people think quantum computers are just faster supercomputers. They are not. They are fundamentally different. A classical computer, like the one powering your SoFi active investing dashboard, thinks in binary, ones and zeros. A quantum computer thinks in probabilities. It explores multiple solutions simultaneously. This capability is paramount for material science. Imagine trying to find the perfect battery chemistry. A classical computer has to test every combination one by one. A quantum computer can perceive the entire landscape of possibilities at once. This is why the automotive industry is interested. This is why the defense sector is interested. The government contracts IonQ has secured are not just revenue. They are validation. They signal that the United States government views this technology as critical to national security. When you are assessing an investment help tool or looking at investing sites, they rarely quantify geopolitical importance. But for IonQ, that is a massive hidden asset. Speaking of assets, I want to hear from you. Comment below how many shares of IonQ you currently hold, or if you are waiting for a specific price point to enter. Do you think the volatility is scaring away the institutional money, or is it a smokescreen for accumulation? Let me know your thoughts. Continuing with the analysis, we need to address the risks. It would be irresponsible to paint a picture of purely blue skies. The cash burn is real. Building quantum computers is not cheap. They require vacuums deeper than space and lasers more precise than anything else on the planet. This means IonQ will likely need to raise capital again in the future. For the shareholder, this means dilution. If you hold Robinhood fractional shares or a small position in a SoFi ETF's portfolio that includes quantum, you might not feel it as much. But for significant holders, stock offerings can be painful. This is the tax you pay for innovation. You are funding the R&D department of the future. The expectation is that revenue will eventually overtake burn. The reality is that this crossover point is still years out. The stock price today is a bet on that crossover happening before the money runs